Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Gemma Mitchell, welcome to this episode of the Australian Finance Podcast. How are you going?
Great, thank you. Nice to be here again.
Nice to be here again. Always good. It's very sunny where you are, and you told me that you're blind halfway down. I guess that's why they call it the Sunshine Coast.
Yes, and we've had so much rain. It's actually a really nice, it's a nice rest from the rain. I put all my outdoor furniture back out yesterday because I was like, I think the cyclone's well and truly gone, and it's stopped the torrential rain.
Well, it's all good news then for people up on the sunny coast or southeast Queensland. It was a bit hairy for a while, but it looks like things are on the mend now, which is great. Normally we start our weekly Q&As with a bit of a, how are you going? What have you been up to? Like, what have you been working on? What's happening in the world of Gemma?
So a lot. I did something really exciting this week. Well, I finished something really exciting this week. I guess it's like a soft launch I got a book deal and I had to submit it this week. So I haven't talked about it before, but that is all done, which is really exciting. So that was a huge step.
So can you tell us more about it at this time, or are you going to...
I think I'm going to wait because it's in with the designers at the moment. I like we're pretty set on the title and everything, but it's with the designers and stuff can still change. So that is all that I'm going to put in my little soft launch on that.
Okay, so we will get full deets on this over coming months.
Yes.
Matt, can you are you able to tell us anything like when the book may be out?
Yeah, it should be August, September is when, and I should have like a copy of it and that, like the cover and all of that in early May. So I'll probably start sharing it there. So cool. Really, really soon.
That's not far away at all. So there's a book coming. This is going to be exciting. So people will know you from social media and the different things that you do and the different brands that you have as well. And so you've done a lot of good work over the years, just educating people in different ways. So hopefully this is a consolidation of a lot of the lessons learned. And
it is.
Really
it
helpful.
is. And there's so many amazing finance books, and this is going to complement them very, very well. So definitely not replacing what's already out there. It's will be very complementary. So.
I'd say that it doesn't probably need to be released, right? Like, it doesn't need to challenge those books. It needs to be released, but it doesn't need to challenge those books in any way. It should complement them because there's so much good work that's already been done.
Oh, amazing stuff. So and I'm all about getting people back on track when things have gone a little bit pear-shaped. So that's what the book is about.
I've actually final thing, amazing. I've known this has been coming for a while, so I'm glad that you
feels like forever.
But it's really exciting. But it's interesting that you say that because in the last week or so, I've caught up with many different people who are interested in getting financial advice, and there's this definite category of Australians who are restarting after something, whether it's separation is really common, whether it's I don't even know. Maybe you could say restarting after kids, leaving the nest and thinking, well, now it's time to prioritize my future. Or maybe it's, going down to a single income and you kind of feel like you're resetting your budget and your goals. And there's so many moments in life when people do go through those big changes, and to have a resource like that will be really, really valuable.
Yeah, and that's it. Like, it can be like an internal kind of awakening, like, what am I doing? I need to reset everything, or it can be those external factors. So something in it for everybody. But yes, so that's very exciting. And then the other thing I was going to tell you, I've had 10 people reach out. So our last episode was remember we touched on novated leases?
Oh, yeah.
So I've had about 10 people reach out, no exaggeration, with horror stories on leases. Yes. Yeah.
Maybe we need to do a full episode on that.
I think we do. I think we absolutely should.
Well, what if you could summarize some of the horror stories? Like, how do people get in such bad shape with a novated lease?
One of them was trying to get out of it early and not realizing all of the additional costs that were going to go on, and it started off at like 54,000, and then when they went to pay it out, it was 80 something. Plus, they'd already paid off all these repayments. That one seems really weird. So they're looking into if there was errors or whatever. Others just lots of financial advisors going stuff that they've seen, and just clients saying, I got into it because it was promoted through work and didn't really understand what it was. And but it would be good to do a whole episode on that. Maybe we could get an expert, like an accountant or someone.
Yeah, for sure. I know Pete in our team has done a lot of stuff with novated leases over the years, but it's interesting because there was an AFR article I saw this past week with Australian Financial Review, for folks that don't know the acronym. And it was basically talking about like the electric vehicle subsidy. So I bought our electric vehicle through our business, but if you don't have your own business, basically the way a novated lease, the proponents of a novated lease will effectively say it's kind of like having a car paid for by your business or by your salary kind of thing. It's a bit different. There's a few things that go into it, but the IFR article that I read was like really skeptical of the electric vehicle exemptions for people that go and buy their vehicles this way, because at the moment there's this, like, I would say it's a tax loophole. I'm just going to call it what it is. It is amazing if you go and buy a fully electric vehicle right now. Yeah, I think it's fantastic. Doesn't have to be through a novated lease, mind you. Maybe talking specifically to business owners, tradies, that sort of stuff. But this article was pointing out that like maybe there's been some, misjudgments and miscalculations in how many people would take out a novated lease to go and buy an electric vehicle. So that's maybe an episode for next time, but that's really, really interesting stuff. One final thing on this is a lot of the people that represent novated leasing organizations do get access to employer kind of like EAP systems. Like a lot of employers will put on like a finance workshop for you and your team, and it will be from someone who is representing one of these companies. And it does sound really appealing. So just before you get involved with it, just getting a second opinion, like go speak to your accountant and actually talk through the mechanics of it, because you don't want to end up like what Jem was saying. It's I've seen it a lot as well.
Yeah, but they definitely do work. Like one of my best friends right now, she's sending me all her quotes, and she's like, and I've done this research and I've calculated this, and she's such a numbers girl that I'm like, I believe you that if you've done this much research, I'm sure it's going to work. Like, so some it definitely does. Just I would say not hard and fast rule. Yeah. How's your week been?
Good. Yeah, we've, as you know, we've had 2 more financial advisors accept a position at Rask. So that's been super exciting. And one of them actually has a novated lease that he is transferring to Rask. So that was a bit of a thing for me because I'd never done it for someone else coming into a business. So that's going to be interesting. But, that's what's consumed me a lot this week, Gem. As you know, it's been, starting a financial advice business is incredibly taxing, from everything at like the license and the regulations right through to team and managing people's expectations, because it is quite complicated to offer financial advice in Australia. So we really appreciate everyone that's already joined the waitlist and signed up and has already begun their journey with us in that respect. So that's been really exciting. Other than that, did a bit of a shop. I bought a couple of shirts from Uniqlo, I got to admit.
You went to somewhere not Patagonia or whatever it's called?
Yeah, I did. And I'm wearing Patagonia right now. Flanny t-shirt. But I think I don't know, I feel like the move into financial advice is prompting me to get more collared shirts. So watch this space. I may one day appear on the Australian Finance Podcast looking like someone from finance.
In a full suit.
Yeah. So we'll maybe not full suit. I feel like I get really itchy in that.
We'll
see. Definitely, that's been a heap of fun. But I think the big thing that's happened is not so much just this week, but probably the last month. There's been a lot of fear amongst investors. So whether you're investing in ETFs or you've got direct stocks in particular, it's been a pretty scary couple of weeks, maybe a couple of months for you. Gem, I know you did collect some titles here of articles that you managed to pull up just this morning that you've read across the internet. So what are they?
Yeah, so I always like to talk, like the media loves to dramatize things. And yes, a lot is happening, but there's some pretty scary titles. So it's no wonder that people get terrified when they open Google, because I just put in like Sharemarket and these crazy titles came up, like analysis warns no end in sight for share market fall. Millions watch their super. 4 trillion wiped off. Why did the all odds crash 22%? Aussie market, Wall Street plunge, US market crash. Like these are just like title. Like I know it's clickbaity and there is some good information in there, but yeah, I absolutely understand why people panic. But I will say, on the flip side, while I was looking at those, I also saw some great articles. So we should actually call them out as well. I only picked the scary ones, but some were like, what have we learned from all of the other crashes? You know, why it's still a good time in the market. Like there were some good ones, but usually the ones that get our attention are those scary titles.
Yeah, absolutely. Those ones that confirm our beliefs. And oftentimes when it comes to managing our own money, even if it's, $50 or 500,000, we often think that other people know something that we don't. So we think that, it's gone down. I don't understand why, but someone would, right? And so we then jump at the news sources and we find these experts that have heard it all before or seen it all before. And we kind of overvalue their opinion as if they have some sort of crystal ball. And this is it's a genuine thing. Like because we manage people's money, right? We can see the emotions of people in the different comments that come through. It was interesting because we've been managing our investments for quite a while for our community. And the last time we had a meaningful, well, no, it wasn't even that meaningful, but the last time we had a fall, we actually saw that our investors who had already invested with us invested more money as the market fell. And so I think that people who take a little bit of time to understand why the stock market tends to go up over time, not every month and not every year, but they take the time to understand that and they're a bit more comfortable, they see negative as positive. They see market fall as opportunity, not necessarily as fear. It's when people don't understand anything about it that then they make bad decisions with their money. The reality is this, Gem, that in the last few months, Trump and the US, the US president and his administration have basically just tried to just rattle cages around the world, like rattle relationships, the old America First type principles, even with our own government, tariffs on steel and these types of things. And it seems really scary at the time, but I think for most people, just remember we've been here before, not only just with a Trump as president, but think about all of the scary times that we've faced over the past 5 years, let alone the past 20, 50, 100, 150 years. And in that time, like over 150 years, the stock markets, the companies on the stock market have increased their profits on average between 6 and 7% a year. So not every year, but if you just think about why does the stock market go up? It's because companies solve bigger and bigger problems for the world as time goes on. And that's really it. Like if you think about like AI as an innovation, that's something new over the last few years. That's solving more problems in healthcare, in mathematics, in business, in your own life. And so that's an example of an innovation that continually makes businesses more profitable through generations. And that's why the stock market goes up. And so the final thing I'll say here is the longer you zoom out, the more comfortable you will be. So if you've got your stock portfolio or your ETFs or your tracking system set up to daily price movements, or you read the daily news, your emotions are going to be way more volatile than someone that just gets the monthly headlines or the yearly headlines or the quarterly data. Like a financial advisor, Gem, a final thing I'll mention, a financial advisor, when they deal with clients, most of the time they give them quarterly reports, not daily reports, quarterly reports. So that's a good time to check in, assess reassess, and make a plan for the next 3 months. And so if everyone just treated their own investing like that, we'd make far better decisions, fewer decisions, and would feel more in control, I think.
Yeah, and it's about knowing your time frame. Like if you don't need this money immediately, like that's what we're investing for, so we can ride out these market fluctuations. And this is also why we diversify across different asset classes and all of that stuff. But yeah, one of my favorite sayings is, if in doubt, zoom out. And that's exactly it. Like the further you look, the better things will actually feel. And you'll see that this happens all the time. So if the most important thing is you've got your time frame right for these investing funds, you're invested within your comfort level, and you're diversified. If you can say yes to those three, then most people should just be riding it out and not need to panic. But yeah, I see it. I tend to see it as an opportunity. It's like a Boxing Day sale. The shares that we potentially were going to buy anyway are now on sale. So for the same, $100, we can get more for that. So if you're an accumulator and not, potentially in retirement, that's a bit of a different scenario there. But again, that's diversification and your plan with your advisor.
Yeah, and I think a lot of the questions that we've got this week are on or around this topic of investing. So there's a couple of fun ones as well, which we'll go into. But just before we get into the questions, it's really important to understand two things. One is how to send your question, and two, what we can say on the show. The first thing is send your questions in via your podcast player. So if you're on Apple, Spotify, whatever you listen on, YouTube, go into the description and find the link that says Ask a Question, select the Australian Finance Podcast. If you get your question on the show, you can write into us and you'll get a free Value Investor Program, which is a $499 course that we offer, or you can get a free Rask Core membership for 6 months. The way to redeem that is just to head to the Rask websites. In the bottom right-hand corner, there's an instant chat and our team is online, or myself, and we'll give you the coupon codes and the access that you need. Second thing, general advice warning. As you know, if you listen to the show each and every week, we don't give personalized financial advice here on the Australian Finance Podcast or any of the Rask podcasts. That's because we simply cannot legally do that. So anything that we do say, any questions that we answer is strictly in general, and we don't know your needs, goals, or objectives. So speak to a financial planner if you're confused or you want personalized financial advice. Maybe I'll add one more for today, is that past performance is not necessarily indicative of future performance when it comes to investing. And there's a good reason for us to say that, is we don't know what's going to happen in the next week, the next month, or the next year with like specifics. We might know in general based on what's happened in the past, but history, may rhyme, but it doesn't repeat. And I think that's a really good setting for this next set of questions that we have. Gem, where did you want to start?
Well, let's start with one from Chantel, because I was actually interested in this one as well. So it says, is Owen Rask on Twitter? The reason I ask is because I always get suspicious when accounts ask finance questions straight away. So I'm presuming that this person is on Twitter following you and you have DM'd them. So yes. I thought this would be a great question to see, one, if you're on Twitter, but then also maybe tell us where else you are and if you're ever going to DM people.
Yeah, let's start with the second one, which is I don't DM people. And that's because there are so many scammers that try to impersonate us.
We should clarify what DM means.
Direct message.
Direct message you.
Yeah, so when someone tries to message you directly, and if it comes from Gemma, or if it comes from myself, or it comes from any of the Rask team members or hosts, or even the Rask account, it is not us. We won't DM you. And that's a really important thing to understand. If you message us, we might reply, but we're not going to DM you. That's a really important thing. Second thing on that is we would never direct you to something like WhatsApp, Discord, or like one of those platforms that are I always say that if whatever starts on WhatsApp does not end well. And so whether it's your local footies banter chat or something like that, things go on WhatsApp, they probably are not great. So we don't DM. Secondly, am I on Twitter? Yeah, I am. I don't use it as much anymore. Once Elmo got involved, I kind of just slowly faded away. But I still use it a little bit. We stream our live show onto Twitter. What have I got? 11,200 followers on the old Twitterverse. It's a great community, really focused on investing. Actually, I think if you're interested in like direct stock investing, 100% X or Twitter is the best place for you to like connect with people, because that's where a lot of the fund managers are, the professional investors. They're not really on the other mediums, because the other mediums are more video based. But that one is the one to go to and go check out. Well, we will not DM you. My handle is Owen Rask only.
Yeah, and I think like we have the platform, the community platform that's free that you can sign up for via the website. So that's where you can like interact with people and be really confident that there's no duplicates as well. Yeah. So I'll put the link in the show notes to that free community platform via our website.
It's just a
community. That's a
community.
really good place to kind of chat.
Yeah, absolutely. So community.rask.com.au. That is the reason that we set that community up, and the reason why we got off Facebook and all those others with the groups and that is because of that very reason. We were too worried about harm coming to anyone in our community. So we made it hard for people to sign up. When I say hard, it takes about 30 seconds. You actually just have to go to our website and sign up. That is just to keep the people that would try and scam you off of our community. They just should never be on there. And the community self-regulates, which is awesome. So
and now we can say, no, we don't have a community on there, so you won't accidentally sign up with a duplicate and things, you know. So it's as safe as we kind of can be in those platform scenarios.
And let's just final thing on this before we move on from this question. Let's make this a general lesson for everyone. Do not trust things that you like. Do not action things that you come across on social media. And I know that's a very blanket rule, but just do not take that one source of information as being truth or reliable in a way. Like, we post content, but don't act on it. Make sure you have a reasonable basis for it. And the reason I say that, it's very heavy-handed, is that the scammers and impersonators are incredibly sophisticated. In one instance, they actually copied my voice, and they used voice to send messages to people in our community. Imagine how hard that would be to identify whether or not you're listening to this podcast right now or whether it's me talking to you. Do not rely on it.
That's so scary. Hey?
Yeah, do not act on it. And even if it's not us, you know, anyone else or any other brand, just don't rely solely on social media. Use another way to communicate. It's just like clicking on links in emails. Like, who does that kind of thing? Next question came from, actually, we might go to do Archer if that's okay. The Archer sent in a question. I like this one, Gem, because I'm interested to hear your thoughts. This is loyalty programs and subscriptions such as Flybys, Everyday Rewards, Velocity, Costco, etc. They say, are they worth joining, and do they save you money? What do you get in return? Thank you, says the Archer. And it's a great question. So loyalty programs, Gem, we see a lot of this. Every company seems to have a loyalty program these days. The big ones are like, you know, travel points and all that sort of stuff. What do you think?
And then there's like cash back, like cash rewards, shop back and stuff like that.
Yep.
So I personally use a few of them. I'm more like, I think we've talked about credit card reward points before, and I was like, I can't make them work, but I know people that hack them and do it really well. But for the most part, I don't see people doing it well enough to pay the fee, the annual fee and the extras to get the points, but some people definitely do. But in terms of like Flybys, I have Flybys, and like every couple of weeks they're like, hey, do you want $10 off because you got enough points? So I do Flybys. I have Shopback, which I think I've had for like 3 years, and I got like my tally's at like $1,500 back. So I use stuff like that, but I don't know enough about what they do with my like, because obviously nothing's for free. So I probably need to understand more about what's actually happening with my data and stuff. So I use a few of them, and I think it's worth it, but I wouldn't necessarily pay to have those services. I know with Costco, you've got to pay to have a membership. So you would want to weigh up, or how often am I going to go there? And am I actually going to save? Because I once went to Costco with my sister-in-law, and yes, we bought in bulk, but it wasn't actually that much cheaper. I just had all this stuff that I then had to store. So I've never like, maybe I was buying the wrong stuff. But yeah, so I would weigh up, if this membership thing is going to cost me money, how often am I actually going to use it, and crunch the numbers. And I would reassess every single year, like with your credit card or whatever, because one year it might make sense and the others it might not. But yeah, if anyone has any, do you know what they do with the data? Why are they giving me this free money on my Flybys and my Shopback?
Yeah, I mean, I don't use Shopback or anything like that, so I would want to know that too. So if anyone knows, please write into us and let us know specifically about those types of cash rewards programs. But there's two reasons that a lot of those things exist. Number one is when you shop at something like, say, I don't know, the Iconic. Normally, the Iconic would have to run a Google advertisement or a Facebook campaign or pay someone to get you to shop with them, right? And so what those big sites do, like Shopback and all those, is they can effectively aggregate where people like get their products from. So when you visit the Shopback like page or whatever, it would then have an Iconic dress or t-shirt instead of insert something else, right? And so they would actually pay for that privilege to be the first one there. It's kind of like Afterpay Day and just Afterpay in general. Like everyone knows that Afterpay made you or allowed you to pay in full, but who paid for that? Well, it was actually the merchant or the seller that actually paid. So they would actually take it, like Afterpay would take a clip of their sales to offer that service. And then eventually Afterpay got so big that effectively what happened was Afterpay said, if you sign up with us, we're going to increase your sales by 20%. Sure, we'll take, 5% as our profit, but you are going to grow because you use us and you're aligned with us. And so that's where a lot of those things work. There, in my opinion, it's quite controversial. I think most of the credit card hacking is actually putting you backwards. I think that for most people that do the points hacking, it pushes you backwards. For some people, it may work, but you have to be truly committed to it. That's my opinion. There is I love a little bit of a loophole here. There is a loophole though. Some of the points hacking can be done between people that have like business cards and like personal expenses. There's a gray area here, and like you have to be very careful about this. But in some senses, like the points that you get for loyalty programs, if you run your own business or you book flights or you do something like this, a lot of the points are kind of like, whose points are they? Are they their businesses or are they mine? Am I a sole trader? Like it's a bit murky. So there's a potential that you may be able to accumulate points for things that the business purchases.
I think I saw an ATO article on that recently, and it was like, how do they? Because it is like like an income, I guess. Like if you build up enough, it's paying something. So they can't tax points. So it is a bit of a grey area.
Yeah, so you need to be careful and speak to your accountant. But that's something we use. We use Raise quite a bit here at Rask, just because we've got to book flights to and from different places in Australia, and I really like that. A lot of the hotels that we go stay at, we have a membership and we just accumulate points through time. But, for the most part, Gem, we don't make that much of a use of it. I'm sure people out there will say, nah. But I did laugh when you said Costco before, and I knew exactly what you were going to say before the words came out of your mouth, because everyone says exactly the same thing. They go, I went to Costco, I spent $1,000. I don't even know why I needed these 100 lamb chops. And now I just got to freeze them anyway. I need to go back to Costco to buy the freezer to put the stuff.
This was on an episode, I think we were talking like a little while ago about good money, things that are seen as good money habits that can stitch you up. And I think buying in bulk is one of those, because you store, like some people, yes, it works for like credit card points. There's always an exception, but you've got to store it. Stuff goes out of date. You forget that you've got it. Like you spend all this money that impacts your cash flow that could have been sitting in your bank or your mortgage on. So I'm not a fan.
I love it. And I love the way that Costco makes you feel when you shop. So the first thing that you'll ever notice when you go into a Costco store is the big Apple stands, the Samsung TVs, the white goods, the really nice stuff, the diamonds. You'll see all that stuff when you walk in.
Diamonds.
It's trying to make you feel like, wow, this place has really good stuff. That's the emotion. Whereas you walk into a Woolies and the first thing they put in front of you is like the 40, 50 cent, like baked today going out of, on sale type stuff. It's a very different experience. Oftentimes supermarkets try to push you into the fruit and veg department, which is probably a good thing for us.
That's Audi. Yep. Audi does it. And Audi's got everything in the boxes, like, just like,
take it all
very
Yeah, but a lot of them do have particular tactics, and they try and flow you around the store and make you feel a certain way. And Costco does that, because then after you leave that part of the shop, everything else looks cheaper.
It's cheap. Yeah.
Yeah. So
That's very clever.
yeah, it's a really good way. There's a Modern Family skit about it as well. So if you're a fan of that, you'll know what I'm talking about. But I think Costco is a wonderful thing. I think that people confuse it. Final thing I'll say, because I'm a huge fan, is I think people confuse it for being cheap when really what it's trying to be is good value. So they have this kind of mantra at Costco, which is we're not trying to be the cheapest. We're just trying to be the best value. You know, you might get 2 kilos of peanut butter, but it's good peanut butter. So that's the difference. So anyway, let's move on.
And
Otherwise I'll
just
keep going.
disclaimer, they're not a sponsor of the show.
Yeah, no, they're not. But I am a member. Another question come through. There's a few investing questions. Why don't we start with the easy one, which is Nervous Newbie, which this is actually, it says it all in the name, to be honest. Nervous Newbie, what a great name. What happens if these platforms like Perla or Stake were to go bankrupt? Would you keep your shares? Sorry, probably a really dumb question. This is not a dumb question. And they say, loving the pod. This is probably the most important question. Like, it's your money. Let's make sure it's safe. With those two, so it's important to understand how stock brokerage accounts work and how the stock market works. In Australia, and in particular with those two platforms being Perla and Stake, they offer something called HIN trading, which is where you own the shares in your own legal name, even though you buy them through them. So if they were to go bankrupt in this instance, you would have this unique number that gets sent to you in the post or via email, and you can use that number. And if Perla goes broke, you can then go to CommSec and you can say, hey, CommSec, this is my number. Can you bring the shares that I own across here? And that's because under this, what we call chess, just think about it like the game of chess, under this chess system, the ASX effectively records each individual investor, the Australian stock market. This is very unique to Australia. But outside of that, even if you go with a brokerage platform that doesn't have that, the global standard is what we call a custodial model. It's where money's pulled together. It's very, like, brokerage accounts do go bust, but the regulation is very, very good in Australia, provided you follow the steps that we outline in other episodes and on our website. There's an episode coming up on how to get started investing in Australia. I've done a 20-minute episode that takes you through some of the platforms and how to look at them as well and how to study them and make sure they've got all the checks and balances. So that's coming up soon on the Australian Finance Podcast. I hope that helps.
Yeah, I think that's good. I actually had a call about this the other day. It might actually be the same person. But the other question that they had was, in Australia, we have the 250,000 deposit guarantee, and they were asking if that's covered on things like broking platforms. And it's not. It doesn't cover superannuation or broking platforms. It covers bank deposits, like bank accounts.
Yep. And in Australia, I can't remember the name of it. It's like the Stockbrokers Reserve Fund Scheme of Last Resort thing. Basically, a few years ago, everyone listening to this can go back and look it up. We've had brokerages go bust here in Australia, like Opus Prime. We had BBY not too long ago. And what you find is that when people invest with those stockbroking firms, when people have HIN-based holdings, so they've got their own number, it tends to just be an administrative thing. Like, you just go to the other brokerage platform and you just take your shares across. When you go to the custodial model, ideally it's the same process, but it can take a little bit longer. It's a bit more of a pain. There are a few other steps to follow. We've got questions about this, so I'll bring it up now. Our investment platform, which is Rask Invest, is also built on HIN technology. People miss that. It's actually just like a brokerage account. It's just that we manage it for you. That's the only difference. So keep that in mind. But we don't say that you have to go with something that has one of those unique numbers. It's just that it's an added layer of safety for people that are just getting started. Stake, Perla, Self-Wealth, CommSec, BetaShares Direct. What else is really well established? NAB Trade, CMC Markets. All of these organizations have been around for a long time. And I'm confident to say that if you're just getting started, you can try them out, read the financial services guide, check to make sure it's right for you, speak to an advisor if you're concerned. But the good thing about all of these, Gem, is that if you're new to it, you can start with many instances $50 and just try it out, or $500. You don't need to bet the whole house on it. So I hope that helps newbie they're nervous newbie.
Nervous newbie.
Yeah.
But that's a great flow into one of the other questions that we have, talking about the model portfolios that are on that platform, because one of the questions came from Warren Buffett Jr. with, what is the benefit of following Owen's model portfolios over investing in VDHG? So that's Vanguard Diversified High Growth.
Yeah, sure.
The ETF.
I've done a deep dive on this in the Rask community because we obviously got a lot of questions about it. And now that the Rask Invest platform is starting to pick up a bit more steam, and people are investing more than ever, it's a question that we get asked a lot. And the thing is, I believe that the diversified ETFs, like the Vanguard ones, actually, Gemma, I realized I didn't make it I want to make a disclosure before. I mentioned BetaShares Direct and Perla. Both of those two organizations who we love are long-term advertising partners and sponsors of the Australian Finance Podcast. I just want to make that clear before I move on and before I forget. Moving on. With these ETFs, like VDHG, which is the most popular diversified ETF, it's like an all-in-one ETF. There's DHHF from BetaShares. There's a new range of ETFs from Vanguard, actually, All Growth, for example, 60/40. I think these are all great. And I think for people getting started, they're pretty wonderful. And I think if you have someone in your family or your friendship group, without giving them financial advice, you say, check these out because I know you're not going to really care about anything I say after. You could probably look at this one. Those are the ones that I would push people to, because for the most part, they do a good job. And I think they're safe and secure and all those types of things. Where it gets a little bit in the details is that once you actually pop the hood on these ETFs, a lot of people don't actually understand how they're constructed, what rules they follow, or if that's going to be appropriate for them, not just now, but 10 or 20 years from now. And I have a bit of a concern that some of the investors who use things like VDHG and the other diversified ETFs is that they're not always fully considering the future. Because most people, when they set about investing, they choose the lowest cost brokerage account, the lowest cost super fund, the lowest cost this, the lowest cost that. But really, if you're just starting out, it doesn't matter, because your balance is smaller. Your chances are the decisions that you make, you can recover from. But what would your 20 or 30 or 40 year from now self think? Would they have wanted you to have a bit more control, or to, for example, be a bit more future-proofed? I think those are the questions that people should be asking. And so the reason why we set up Rask Invest the way we did is effectively so that it's not just a one-size-fits-all. For example, if you wanted to go from our high growth strategy to our 70-30 or 70% growth, 30% defensive, or our balance strategy because you're coming into retirement, you can just go into the account, switch portfolios, and we would tax effectively only sell the ones that needed to be sold to rebalance the portfolio. Secondly, another thing is that we can invest in virtually anything that's on the stock market. So like we could add, for example, an active fund manager. A lot of people don't know that inside of these ETFs there's automatic rebalancing, which if you're on a high income is one thing that can really give you the irrits. And sometimes that's not right for everyone. And so there's a few different reasons, but ultimately for me, it comes back to a little bit more control for our investors, a bit more control over, well, what happens if index funds aren't the best thing to do in 5 or 10 years? I don't want to scare anyone because I think they're great, but just having a little bit more flexibility, a little bit more control, we see that as a massive benefit for people. And people pay us a fee of 0.55% is our fee. It's pretty small when you've got not that much. Like if you've got 20 grand, 50 grand, 100 grand, it's still a great amount of money. But if you think about like the future of you, it's not going to be what you retire on, but it's a really good starting point. And the best thing of all, Gem, if you don't like us, you can leave. And you can just take your HIN number, because it's all in a HIN, and go to one of the brokerage accounts and be like, all right, Owen and the team set that up for me. I've got this in motion. I'll just keep doing it myself from here. And that's the power of the HIN model. So I hope that answers questions. I'm happy to explain more in the community. Just ask me any questions you want. Please don't invest with us until you've read the PDS. I wouldn't want you to anyway, because if you don't take the time to read the PDS that we put out there to explain why we do what we do, at the next sign of the market falling, you might be a bit panicked and you might sell out.
Mm-hmm.
Yeah.
Absolutely. Great.
Actually, can I add one more thing here, Gem? Is if you think about the world of investing and you think about the last 3 years or the last 5 years since COVID, basically, the investing world has been absolutely amazing. Over on our Australian Investors podcast, beginning of last year, so 2024, we said this is probably the best time in our careers ever to invest. Everything was looking good. Property was coming off a bit of a weak spot. Bonds and fixed income were looking really, really good. You could get great term deposits. The stock market was cheaper. Like there were so many things that were in your favor. And now you fast forward to the end of 2024, so the beginning of this year, and everyone thought they were geniuses. And then 3 months into this year, all of a sudden things have got shaky, like really shaky. And now people are realizing that they probably didn't know as much as they thought they did. And Charlie Munger said it best when he said that compounding is very powerful. Don't interrupt it. And if our only purpose in this life as investors is to help other people stop making those bad choices at the wrong times, then our fee more than covers itself. I don't want to promote it too much, but that's the gist. So hopefully that helps answer this question for Warren Buffett Jr. All right, we've got one more question, Gem. What is it?
Last one here is from Sheeptopia. Love it. I hear about having a diversified portfolio is key. I'd appreciate some discussion about what actually is a diversified portfolio. Should it be majority ETFs? If so, what ETFs? So I think this is probably a good one because we always talk about diversifying, but just assuming that people know what that actually looks like.
How do you think about it? Like, what do you do with your money, Gem? Like, without being too specific per se, but like
spend it on handbags.
You spend it on handbags. And
I invested it.
Did you spend it all on one handbag?
No, I diversified.
You diversified, right? So you've got something for different seasons?
Yes, different brands that might hold their value different. But yeah, so essentially diversification is that concept of don't have all your eggs in one basket. And the reason that we would say don't have all your eggs in one basket is because if you like trip and fall and they all smash and that type of thing. So you don't need, it's about having, things spread across different places. So if you think about what's happening in the market right now, it's about the share market kind of all doom and gloom. But if you have a portfolio, whether that's an ETF, several ETFs, your super fund, there might be cash, fixed interest, bonds, Australian shares, US shares, and then different things like infrastructure. So there's lots of eggs in different places, and the chances are that they're not all going to go down at the same time. So some different asset classes will be propping up, what's happening in other areas. And then within each of those actual, like if you think of it like a pie, within cash, fixed interest, bonds, there's also lots of different things in there. So your Australian shares isn't just all one Australian share. There would be, maybe hundreds in that piece of pie as well. So things are very, very diversified in a lot of, depending on the ETF that you're in or your super fund. So you can get things that do a lot of that for you. Or if you're doing it yourself, you want to make sure that you're covering different industries and things.
Perfect.
That's my take.
Perfect. As a hot take, I like it. So while you've been talking about that, I'm bringing this up for anyone that's watching rather than just listening, but I'll walk you through it, is you probably don't realize it, but if you invested at the beginning of 2025 in an ETF known as the BetaShares FTSE 100 ETF, this is an ETF and all it does is take your money and invest it in the largest companies from the United Kingdom. What a place to invest, There's Paddington Bear and other things that you like that come from the UK. So why not invest there, right? But people don't think about that when they think about overseas investing. But we can see on this page in front of us, just humble Google Finance, this ETF, the UK ETF, is up 7% this year. But then if we go, well, isn't the United States the best stock market? Microsoft, Amazon, Nvidia, Tesla, that's down 7% or thereabouts this year. So the S&P 500 ETF from iShares, it's IVV, is the ticker symbol, the one that we own, is down 6.56%, not including dividends. And so at the beginning of the year, a lot of people were still just piling into, American shares because why not? AI, technology, Donald Trump was coming in, his mate Elon Musk, surely that's good for business. And so ultimately, it was the opposite. And if you'd invested everything in that one ETF or that one place, you might have lost. And so what we do by diversifying, people think it's a bit boring. Why not just be 100% in the NASDAQ? Why not be 100% in this one technology stock? Why not be 100% in Bitcoin? The way I think about diversification is if you've got a truly diversified portfolio, you'll never do better than the best thing on the stock market, but you'll never do worse than the worst. And the worst is pretty bad. So you want to be somewhere in between. And by diversifying, you actually, it doesn't mean you don't get any growth. That's one of the things that people kind of think is that, oh, well, I spread my eggs around, I'm not going to grow anything. No. It will still go up over time. It will just be smoother on the way up. And to give you some real practical guidance here, most retirees, they have about a 50-50 balance between what we consider to be growth investments and defensive investments. So things like bonds or cash or those types of bit more boring stuff. And on the growth side, you'd have Australian shares, US shares, European shares. You could have all different types of stuff, property, gold, all those types of things. So we try and smooth the journey through time, but a retiree starts at 50-50. And if you want more growth, not too much more, but you can dial it up a bit. And that's if you need a basis for this, Gemma, I think the best starting point for anyone to understand what diversification looks like, go to your super fund, look at their investments page and see what their overall mixes are. And that's a really good sense of what are the different versions. Like, what does growth look like? What does high growth look like? What does defensive look like? What does balance look like? Great way to start.
On that super point, I often see people like accumulators, not retirees, because that's a totally different topic. When they're drawing from it, can make sense to have different buckets and investments. But I'll often see people in accumulation, younger people, pick a few different options within the super fund, thinking that they're diversifying. And sometimes that's not actually diversifying because, for example, if you pick the balance fund with the super fund and then a growth fund, they've generally got all of the same holdings, just different percents. And so it's not really diversifying if you've got the same assets in there. It's totally fine if you want to do that, but they think they're diversified when really they're not. So I guess that would be the same with your ETFs. If you like, what ETFs could we compare? Like the Vanguard High Diversified Growth. And then if you had the beta share version of it, you'd have a lot of the same holdings.
Yeah, exactly. So if you did like a good one is you wouldn't invest in like the VGS ETF, which is the most popular Vanguard global one, and the IVV one, the one from iShares, which I just mentioned before, and the NASDAQ one, the NDQ one from beta shares. You wouldn't just invest in all three of them thinking that you're diversified because they're all going to have Apple, they're all going to have Microsoft, they're all going to have Nvidia, they're all going to, keep going on and on and on. It's not true diversification. So you're looking to pop the hood a little bit, make sure that the actual things inside of it are a bit mixed. And again, super fund on the homepage is probably a good guide, but you don't need to just keep adding more of the same thing. That's an example of what Peter Lynch might refer to as diversification, where you just get more complicated, but you don't get any of the benefit. So keep that in mind too. Now, if you do have any questions for us, if you're listening to this and you're thinking this is a good discussion, you can head over to the Rask YouTube channel. And in particular, on Friday, the 14th of March, Mitchell, who's our head of funds management, and myself are doing a live show. It's at midday. It's available for on record. So if you watch it, on replay. So if you watch it back, that'll be really helpful for you. We're actually going to dive into all of our current holdings and answer questions of like what's going on in the stock market at the moment. Why is everyone so scared? And we'll tell you pretty much what to do from here, like how to cope with it, answer your questions live on the program. And if you don't get a chance to jump on live, that's okay. You can just send us in a question for next week here on the Australian Finance Podcast. So just to recap, we've had some good questions come through. We've had questions about, is Owen Rask really on Twitter? I am. But I won't DM you. If you want to DM me, just head over to the Rask community. It's free. And Gemma won't DM you out of the blue and talk about crypto either. Sheeptopia asked about diversified. Like I said, most retirees start at 50-50. Younger people start with more in their growth bucket. What happens if the platforms like Pearler and Stake go to bankrupt? Well, most of the time you'll be fine. Just make sure that you are investing indeed with the real Pearler and the real Stake. There is a video coming on that. Portfolios, our portfolios versus VDHG, both good options. It just depends on what level of control you want at the end of the day. The Archer writes in and says, loyalty programs, good, bad, or something else. I think they can be good, and Gem said much the same, but just be careful. They're not always all they've cracked up to be. If you want to follow Gemma on Instagram, you can. It's easy done. We'll put a link in the show notes. If you want to get in contact and book a free call with us, you can do that via your Rask account. That's at rask.com.au/account. You can just book a call with us or the team and have a chat if there's something on your mind. Jump into the Rask community. And of course, send us your questions. If you sent us one this week, don't forget to write into us. We would absolutely love to give you something for free to say thanks. So send us your questions for next week. As always, we love to hear from you. Gemma, good luck with the book. We await more information. And
yes, watch this space.
Thanks.
But I will see you in person next week.
Yes, we'll be doing this in person. So send your questions in. Gemma and I will answer them next week here on the Australian Finance Podcast. As always, thanks for joining me.
Great. See you next week.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.